Welcome to Iron Financial. We're here to do one thing and one thing only, to forge stronger portfolios by putting companies under extreme pressure, stress testing them right down to their financial bedrock. And today, Ecolab is in the forge. The stock just hammered out a brand new 52-week high, and let me tell you, the buzz on the street is getting loud. But here at Iron Financial, we know a peak can be one of two things. It's either a launch pad rocketing to new heights, or it's the crumbling edge of a very steep cliff. So we're going to put this company under intense pressure and see if it cracks. Is this a solid industrial-grade component for your portfolio? Or is it just a high-priced trap waiting to spring? Let's find out. All right, let's get right to work. We are running our standard 5-part structural analysis. No shortcuts. First, we're going to tackle the event that put Ecolab on our radar in the first place, that 52-week peak. Then we will deconstruct the earnings report, the engine that supposedly powered this entire move. After that, we inspect the financial bedrock. I'm talking about the balance sheet that has to support this entire valuation. It better be strong. Next, we'll consult Wall Street's blueprint, see if the pros are building up their positions or if they're quietly bailing out. And finally, after weighing all the evidence, we will forge our verdict. So let's get right to the catalyst. The reason Ecolab is on the table today is simple. The market has cast its vote, right? It shoved the stock to a new high. And that's a pretty clear vote of confidence. But, our job isn't to just follow the crowd. It's to inspect the foundation before we commit our capital. Crowds get euphoric, crowds chase momentum right off a cliff. So let's look at the hard number that really started this whole conversation. And there it is, $294.84. Look, you can't argue with the tape. That is a powerful, powerful signal of momentum. In a market like this, strength begets strength. Capital flows into the winners, and right now, Ecolab is wearing the crown. This wasn't some random low-volume spike either. This was a decisive move, and it came right on the back of their earnings report. The market is speaking, and it's telling us it likes what it sees. This, my friends, is what a breakout looks like. Hold on. Let's just pump the brakes for a second. A 52-week high is a data point. It is not a conclusion. Is it real momentum or is it just euphoria? Is the stock actually breaking out or is it about to break down from sheer exhaustion at the top? I mean, think about it. Chasing a stock at its absolute peak is one of the fastest ways to buy high and sell low. So the critical question we have to answer today is whether this price is justified by rock-solid fundamentals or if the market has just gotten way, way out over its skis. Are we standing on a solid summit or are we floating on thin air? That is the perfect transition, because to figure out if this peak is stable, we have to inspect the engine that powered it, the latest earnings report. This is where we separate the precision-engineered machines from the flawed designs. The numbers always tell a story, but you have to look really closely at every single detail to read it correctly. So let's dig in. What did they actually report? And right away, we get a split verdict, a classic mixed report. On one hand, you've got the earnings per share, the bottom line, coming in at $2.08. Now, that beat the consensus estimate by 2 cents. This points directly to disciplined execution. It shows that management has strong operational control and they know how to translate sales into actual profit. That is the bull case in a nutshell, efficiency and discipline. But you can't just ignore the other side of that ledger. Look at the revenue, $4.19 billion against an estimate of $4.2 billion. Yeah, it's a razor-thin miss, just $10 million, but a miss is a miss. And when a stock is priced for absolute perfection at a 52-week high, even the smallest crack in that top-line growth story can become a huge structural problem. You can't just cut your way to greatness forever. You need sales growth. Now, here's what's really interesting. Let's put that revenue number into context. While, it may have missed the whisper number by a hair, the business itself is still growing. Revenue was up 4.8% compared to the same quarter last year. This is not a company that's shrinking or stagnating. It demonstrates fundamental business expansion. They are selling more of their products and services than they were a year ago. That shows a solid, positive trajectory. It's not explosive, I'll grant you that, but it's steady. And in this economic environment, steady is strong. But come on, the market doesn't trade on the past. It trades on the future. And this is where my skepticism really kicks into high gear. Look at their forward guidance. For the full year 2026, they're guiding to earnings between $8.43 and $8.63. And the key phrase here is that this is slightly above estimates. Slightly. For a stock that's hitting a brand new 52-week high, is slightly above really enough fuel to keep climbing? It just feels like all the potential upside is now entirely dependent on perfect execution. Any hiccup, any little delay in volume recovery or margin expansion, and this stock could be extremely vulnerable. There is absolutely no margin for error built into this price anymore. And that's exactly the right question to be asking. The answer lies deeper in the financials. See, the earnings report, that's the flashy headline, but the balance sheet, that's the bedrock. This is where we find out if we're dealing with a fortress built of steel and concrete, or if it's just a fancy facade on an overpriced piece of real estate. So let's check the structural integrity. The first steel game we are inspecting is return on equity. For anyone new to this, ROE is a simple but incredibly powerful metric. It tells us how efficiently a company is using shareholder money to generate profit. You can think of it as a grade on management's performance. And at 22.55%, Ecolab is getting an A+. This is a very, very strong number. It's a core sign of a high-quality business that knows exactly how to turn investment into profit. And this slide, this brilliantly illustrates how they achieve that stellar ROE, a net margin of 12.49%. Now, for an industrial-type company, that is incredibly robust. It speaks directly to their pricing power and their operational efficiency. It means they can charge a premium for their essential products and services, and they manage their costs with an iron fist. This margin is the buffer that protects the company. It's a sign of a wide, deep moat around the business. Okay, now let's talk about liability. A fortress can have the thickest walls in the world, but it's absolutely useless if it's built on a mountain of debt. Here, we see a debt-to-equity ratio of 0.83. This is very, very manageable. It means the company is financed more by its own capital than by borrowing. They are not over-leveraged. This gives them the financial flexibility to invest, to acquire, or to weather any economic storm without being beholden to creditors. The foundation is solid. And if you needed any more proof of management's confidence in this financial bedrock, here it is. They just increased their quarterly dividend from 65 cents all the way to 73 cents per share. This is a powerful testament to their belief in future cash flow. You do not raise a dividend unless you are absolutely certain you can sustain it. It's a direct signal to shareholders that the business is healthy, it's stable, and it's committed to returning capital. This is exactly what you want to see from a mature, quality company. Okay. Everything you're saying is true. It's a fortress, it's well built, it's well managed, and it's throwing off cash. I don't dispute any of that. But the best fortress in the entire world isn't a good investment if you have to pay a king's ransom just to get inside the gates. So the crucial point is this. What is the price of admission for all this perceived safety and quality? We've inspected the asset, now we have to analyze the price tag. And here's that price tag. A price-to-earnings ratio of 42.46. Let's be very, very clear about this. That is a premium valuation. To put that into perspective for you, the historical average PE for the S&P 500 is somewhere around 25. Ecolab is trading at a significant premium to the broader market. The market is charging you over $42 for every single dollar of Ecolab's annual earnings. For a company with revenue growth under 5%, that's incredibly steep. This tells me that every piece of good news you just mentioned, the ROE, the margins, the dividend, is not only known by the market, it's fully, and I would argue overly, built into the stock price. There's no margin of safety here. You are paying for perfection. That's a critical point. The valuation is where the rubber meets the road. So, we've done our internal inspection of the company's structure. Now let's look at the external blueprints. What does Wall Street think? Are the top analysts in consensus on how to build a position here, or are their plans conflicting? Let's see what the pros are saying. Well, the consensus rating is a moderate buy. On the surface, that looks pretty good. You have 10 analysts with a buy rating and 1 with a strong buy. That's 11 experts telling you this is a good place to put your capital, with a consensus price target around $297. For the bulls, this is clear external validation. But hang on, look closer at that donut. 6 analysts are rating the stock a hold. That's not a small minority. That's nearly a third of all the analysts covering the company. It tells you that a huge chunk of Wall Street is sitting on the fence. They see the quality, but they're balking at the valuation, just like we are. They're essentially saying, it's a great company, but not a great stock at this price. That is not a ringing endorsement. It's a sign of a deep, deep debate about the risk-reward here. The analyst ratings are one thing, but I always want to see what the insiders are doing with their own money. They have the most information. Are they putting their own cash on the line? And here, the signals get even more conflicted. We have 1 director buying and 1 executive vice president selling. This is a classic case of mixed signals from the people who should know the most about the company's future. Let's start with the bull signal here. Director David McLennan recently bought 750 shares, spending nearly $200,000 of his own money. Now, that purchase only increased his total ownership by about 3%, I get that, but it's still significant. Look, there are 1,000 reasons an insider might sell stock, but there's really only one reason they buy. They believe the stock is undervalued and it's going higher. This is a direct vote of confidence from a member of the board. That carries weight. Okay, but you can't just brush past the other side of this transaction. This isn't just any sale. Executive Vice President Boo Alexander AD sold over 1,400 shares. But the crucial point here is the percentage. This sale represented a nearly 20% decrease in his ownership stake. 20%. That is not just trimming a position for diversification. That is a significant reduction. Why would a top executive, someone deep inside the operations, liquidate a fifth of his holdings right after the stock hits a 52-week high? To me, that's a massive red flag. That action screams, I think the stock is fully valued and I'm taking my profits off the table. That action speaks volumes louder than any press release. All right, we've examined the peak, deconstructed the earnings, we've stress-tested the balance sheet, and we've reviewed the blueprints from Wall Street and the insiders themselves. We have conflicting data points all over the place. Now it's time to put it all together. We need to weigh the strengths against the weaknesses and forge a final actionable verdict. Is Ecolab an opportunity at this level, or is it a trap for unwary investors? So let's summarize the weigh-in. The bull case is built on a foundation of pure operational excellence. You have the earnings beat, which shows discipline. You have fortress-like fundamentals, stellar return on equity and net margins, a very manageable debt load, and a growing dividend that signals confidence. This is a high-quality, blue-chip operation. But the bear case is all about the price tag and the sentiment. That revenue miss, however small, suggests growth might just be topping out. The PE ratio of over 42 is undeniably expensive, leaving no room for error. The analyst ratings are clearly split, showing a serious lack of conviction. And that insider sale of nearly 20% by a top EVP, well, that's a deeply concerning signal that you simply cannot ignore. After weighing all the evidence, here is the iron financial verdict. Ecolab is a well-built, durable, industrial-grade company. The foundation is solid, the management is disciplined, and the business model is resilient. There are no fatal flaws in the company itself. However, the stock's current price reflects all of that quality, and then some. Therefore, our verdict is that Ecolab is a component for a conservative portfolio, not a catalyst. It's an addition you make for stability, not for speed. For investors hunting for explosive growth, the heavy lifting on the share price has already been done. It's a quality asset, but you're paying a very premium price. And that leaves us with the final question for you to consider for your own portfolio. Ecolab has proven its structural integrity, and the market has rewarded it by pushing it to a new peak. The foundation is clearly set. The question now is really one of timing and opportunity cost. Is this the moment to build a position in a high-quality compounder for the long term, accepting that premium valuation, or, with the stock at its zenith and the easy games in the rearview mirror, is the heavy lifting already done? That's the verdict you have to forge for yourself. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.